It may still be the Easter holidays for some, but there's no rest for investors as the news keeps coming thick and fast. Now, much of the macro will be coming from the other side of the Atlantic in the week ahead, with corporate sentiment surveys due from the New York Federal Reserve on Monday the 17th, yes, Easter Monday, and the Philadelphia Fed on Thursday the 20th. Keep an eye out also for the latest Beige Book on Wednesday the 19th, more formally known as the Summary of Commentary on Economic Conditions. The Beige Book is published by the US Federal Reserve 8 times a year and features anecdotal insight into the American economy across all 12 Federal Reserve districts. The document can influence the Fed when it comes to interest rate decisions, the next one of which is due on Wednesday the 3rd of May. The current consensus is the US Central Bank will leave interest rates unchanged at 1%, though the market is now putting a 55% chance on a fourth rate rise of this cycle at the meeting set for June the 14th. On the home front, 8 FTSE 100 firms are slated to produce results or trading updates in the coming week. They include Associated British Foods, Bunzl, Burberry, Relx, Rio Tinto and index newcomer Rentokil Initial, all on Wednesday the 19th of April, with Reckitt Benckiser coming on Friday the 21st. But for me, the company really capable of causing a fuss is Unilever when it reports first quarter results on Thursday the 20th. Now, I know it's barely 3 months since we last looked at the Anglo-Dutch food to personal care and hygiene giant, which owns Knorr, Ben & Jerry's, Marmite, Persil, Domestos and a lot more besides. But it's hardly been a quiet start to the year for boss Paul Polman and the company, as the share price chart here does rather suggest. That spike in February was the result of American firm Kraft Heinz offering just under $50 a share in cash and stock in a takeover bid, something like £40 a share depending on the exchange rate, an 18% premium to the Unilever share price of that time. Unilever rejected the offer out of hand, and Kraft Heinz promptly withdrew after what was seen as a clash of cultures between the aggressive, margin-focused, acquisitive American predator and Unilever's more patient, brand-focused, long-term approach. Even though the would-be raider went away, the takeover bid did clearly give Unilever a bit of a shock. On Thursday the 6th of April, Chief Executive Paul Polman outlined a new strategic plan in response. First, Polman laid down a 20% operating margin target before restructuring for 2020. Unilever made a 14.80% return on sales in 2016, and we can see the 10-year operating margin history here. Second, the food and refreshment businesses are to be merged to drive cost cuts and growth. Third, as had long been rumoured, the butter, margarine and spreads business has been put up for sale. Fourth, Unilever will launch a €5 billion share buyback programme. And fifth, Unilever intends to raise its dividend by 12% in 2017, though that's frankly less of a big deal as consensus was already looking for an 11% increase. And overall, the shares yawned a little bit when Polman announced the plan, rising by less than 1%, albeit on a down day for the market. That response puts the focus back on the first quarter numbers coming up on Thursday the 20th, and there are two things to watch. First, underlying sales growth. Unilever has a target of 3% to 5% a year. As we can see here, it's undershot that in the last 2 quarters, and the analyst consensus is for just 2% growth in Q1, a 0.5% drop in volume, and a 2.5% increase in price. Second, profits. There won't be a profit figure for Q1, but for the full year, analysts are looking for €8.9 billion for 2017, compared to €7.8 billion a year ago at the operating level. So watch for any comments on the overall outlook. That, by the way, implies a 60 basis point improvement in margin to 15.4%, compared to that new 20% target for 2020. Thank you for watching, and I look forward to seeing you next time.